Audio Jungle. Audio Jungle.
Everyone likes to make those snowmen when it's winter. And once you get a small snowball up and get it down rolling the cliff, it does not stay small anymore. Let us just say that you invested 1000 Indian rupees in the Nifty index, which includes 50 of the most important blue chip stocks in the National Stock Exchange in 2001. And by the time we reached 2020, your investment had turned into a gigantic sum of 90 lakh in the stock market. You might call it a miracle, but we call it the snowball effect. It was in the early 1940s when Warren Buffett, the greatest investor of all time, invested 1000 US dollars in the stock market. And by achieving average returns of more than 20% every year, in 2018, his fortune stood at 86 billion US dollars. So if you are wondering about how on the earth Warren Buffett managed to accumulate those dollars, we have compiled a list of the 5 key takeaways from the book The Snowball, Warren Buffett and the Business of Life by Alice Schroeder, which will explain how did Warren Buffett utilize the snowball effect and how does the power of compounding work in the stock market. Why should you look to get into the stock market as early as possible? Power of compounding interest in mutual funds. And why should we not underestimate the power of a small snowball? Number 1. Get that snowball off and running. Every investor in the stock market simply wants the best out of his or her stock. But no one notices that this is not possible by sticking to the old and weary ways of making money. And most of them are unaware of the wonders the compound interest is capable of pulling off. But if you prefer to grow your money over a long period, you should know about the zeal of the snowball effect. With compounding, your investments give you the best returns, and the interest earned keeps earning interest. In this way, continuity is stapled, which takes your money to skyrocket values. If there is one thing that is common in every great investor, that has to be their reliance on the power of the compound effect and the long-term wonders it is capable of pulling off. Remember, you need to provide that snowball with an initial push to set it off and running. Number 2. The magic of compounding income. Warren Buffett understood this idea of compounding interest at a very young age. And that too at the time when he found the revolutionary book, 1000 Ways to Make $1,000. One of the best way Buffett came across to earn money was by buying a weighing machine. For example, if you bought a weighing machine for 3000 Indian rupees and charge 30 rupees for people to use it, sooner or later you are going to reach that 3000 Indian rupees mark to make up for your investment. And then the compounding begins. Now you can buy another weighing machine and you can get your earning up to 60 rupees at a time, which is going to compound your earnings significantly. Warren Buffett used this idea earlier in his career, and the business consisted of pinball machines instead of weighing machines. According to Warren Buffett, my wealth has come from a combination of living in America, some lucky genes, and compound interest. Imagine the first day of your job in the corporate sector in Mumbai. You are pretty glad that you finally landed a job, but at the same time, you are curious about the boss, who according to some of your colleagues likes nothing below perfection. On your first day, you put in all those hours from 9 to 5, and at the end of the day, your boss hands you some 1000 rupees. And you are quite happy that you earned some money. Now on the second day, your boss handed over the sum amount to you at 450, which means you were paid 10 minutes earlier. Similarly, on the third day, your boss handed those 1000 rupees to you at 4. You were happy and curious at the same time. So you asked your boss, why is it getting earlier and easier for me to get paid? And your boss replied, that's because you worked yesterday. This is the power of the compounding effect. money becomes easier and easier to earn. And in the aforementioned example, the more you work for it, the better it flows for you. Warren Buffett used the power of compound interest for his passion, and that was making money through stock market investing. The amount of money he accumulated under his belt by pursuing a business of pinball machines was used to make his first ever investment. The power of the compounding interest helped Buffett pursue his first ever partnership, Buffett Associates. Well, you might have seen fund managers backing away from risk, but it was the opposite in Buffett's case. He formed a strategy that would allow him to take 50% of the upside, and at the same time, he would also cover 25% of the downside. It was a calculated risk that Buffett undertook, and it allowed Buffett to accelerate the power of compounding. Number 3. The sooner you start, the better it gets. You might say it's Newton and his gravity concept, but one thing is for sure, the longer that snowball of yours take to get down the cliff, it is understood that the bigger it will be. Start your compounding journey as early as you can. Now, Warren Buffett's billion-dollar company, Berkshire Hathaway, was converted into insurance. It allowed Buffett to accumulate some cash earlier, and it would buy him plenty of time to compound his money before an actual payout. In other words, if someone drops $1 on the road, the average billionaire won't even bother picking it up because he will simply think that the time he spends picking that dollar up is enough for his company to make more money than this dollar lying on the road. But in case of Warren Buffett, he will simply pick that dollar up and turn it in a billion. To put the long story short, let us just say that you had some savings in your bank account, and you finally decided to invest them in the stock market thanks to the book The Intelligent Investor by Benjamin Graham, which you came across in a public library. Number 4. Difference between compounding interest and simple interest. You decided to invest 1000 Indian rupees in Tata Steel at an average return of 10%. By doing some basic math, we can say that your returns would be standing at 1100 rupees. Now, instead of spending all that money partying or shopping, as you read the principle of reinvesting in one of the Peter Lane's books, you decided to reinvest your earnings, and that too for a long time. You let it cook. Now that the 10% return rate has started to compound, your 1100 has turned into a bigger amount of 1210 rupees. You see, that is what compound interest is capable of pulling off. That snowball will not be the same snowball by the time it reaches the base of the mountain. What many people investing in the Indian stock market don't know is the difference between compound interest and simple interest. And what even more people don't know is the benefits of starting early. Compound interest means returns on returns, while simple interest means the interest on the principal amount only. While both of them are depicting interest, there is a big difference between both these approaches. Another factor that is often ignored in the stock market is the power of compounding in mutual funds. Imagine your interest is compounded monthly, quarterly, or even half-yearly in some cases, depending on the type of mutual fund strategy you have opted for. Life would be a lot easier for you. Suppose you have finally decided to invest in mutual funds going with SIPs, systematic investment procedures. Now, if you opt for a monthly SIP, your returns are gonna be compounded monthly, and that endeavor will generate significantly higher returns for you guys as opposed to other investments. Most people simply take too long to enter the stock market. The rule of the snowball effect is simple: the longer you let the snowball slide down the cliff, the bigger the snowball. Number 5. Reinvest, reinvest, and reinvest. Now let's just take another example to understand how pertinent your early investments can turn out to be. Suppose you invest some 10 lakhs Indian rupees in the Nifty index on the National Stock Exchange with an annual return rate of 10%. Doing some basic math, we can figure out that this term of 10 lakh will compound into a gigantic figure of 27 lakhs after 10 years. And that is not all, because if you let these investments cook over a long period of time, your initial sum of 10 lakh will be compounded to over 73 lakhs Indian rupees in some 20 years, which is a great result. We often underestimate the power of long-term endeavors and we overestimate the power of short-term decisions. This is the reason why most people think that making the first million is the hardest, because they are simply not aware of the capabilities of the compound interest. Reinvesting your money is of utmost importance if you wanna compound some serious money over the long term. As in the words of Charlie Munger, Vice President of Berkshire Hathaway and the right-hand man of the legendary investor Warren Buffett, one can build a vast fortune if one allows compound interest to work its magic over the long term. Furthermore, he also puts it that the first rule of compounding is to never interrupt it unnecessarily. Charlie Munger. With that being said, when are you planning to make the first and critical investment in the stock market? Furthermore, if you guys want us to make a separate video on Charlie Munger's investing strategy, let us know in the comment section below. Until then, press the like and subscribe buttons and push that notification icon so that you stay updated with everything in the Indian stock market.